I'd like to begin by asking your forgiveness and begging your indulgence. I don't speak Portuguese. I wish I did. But you now, as I have the pleasure of the live translation for the next 15, 20 minutes. Good luck. It's interesting. As Antonio said, my name is David Ray, and my job is to look at the wider world, at geopolitical and economic events, and try to translate what this means for real estate. What I'd like to talk about today and what I'd like to offer is an international perspective on the real estate sector. I have some good news and some bad news. From an international perspective, the bad news is that the real estate sector is in a difficult position. Internationally, we have just come to the end of the bottom of the cycle. We've experienced a downturn in property values, a slowdown in investment activity, in leasing activity over the last couple of years. It's been a tough time. As we came into this year, though, things were starting to look up. But then Donald Trump took office. And it's my view that Donald Trump's policies will considerably disrupt the global economy, disrupt the market, and have the potential to disrupt the real estate market over the next couple of years too. But the good news is that I don't believe he and his policies will have a big long-term effect. I think it will be a limited long-term effect on real estate. In fact, I think it is the structural trends already underway and little affected by Trump that will determine the future of real estate. And I think that future is bright and full of opportunity. Now, I'd like to explore this thesis with you. Back in 2020, even before COVID, the head of the IMF said, if I had to identify a theme at the outset of the new decade, it would be increasing uncertainty. Personally, I don't think the term uncertainty cuts it. It doesn't adequately cover the broad range of challenges that we are dealing with as real estate investors and developers. In fact, not only is it inadequate, I think it is such an oversimplification that it can lead to inaction, to sitting on one's hands. Let's let this uncertainty pass, then we'll invest. We can wait this out, then we'll decide. Or it incentivizes contingency planning over action, and you miss 100% of the shots you don't take. I prefer to say that we are living in a VUCA world, one that is more volatile, more uncertain, more complex, and more ambiguous than in the past. For those of you who haven't come across this term before, it was invented, or it was coined by the US Army War College in 1987. It's used to describe dynamic and unpredictable environments where decision-making is difficult due to the fluctuating nature of the factors involved. This sounds a lot today, or to me, this sounds a lot like the environment we're living in today. And thus, I think it is relevant to our thinking about the real estate sector in the short term and in the longer term. Let me give an example of what I mean. For volatility, think about the financial market volatility we've seen even just over the last year. At the end of July last year, the Bank of Japan raised the interest rate from 0.1 to 0.25%. This caused global financial market disruption, meltdown. The US S&P dropped 6%, carry trades unwound. There were calls for the Federal Reserve to cut interest rates between meetings. And within a month, it had dissipated. At the beginning of this year, we had a global bond sell-off, all because of US policy. This made sense for the US, but didn't make sense for European countries to see their government bond yields rise substantially in yield. That is only now beginning to unwind. And even further, we're seeing the US dollar depreciate, even as the interest rate differential widens. Financial markets are oversensitive, they're overreacting, and this is causing volatility. And it creates dynamic policy risks, as well as increases the risks of spillover effects, such as margin calls and fire sales. For uncertainty, we only need to think about the policies of the new US administration under Donald Trump, a topic I will return to in more depth in just a minute. For complexity, consider the wars that are underway on the periphery of Europe, in Ukraine and Gaza, those in Africa, in Sudan and Congo, and how difficult or imponderable finding a solution to these will be. And for ambiguity, I would point to the post-pandemic economic data. National statistics and survey measures have seen response rates fall, sample sizes shrink, meaning the data is no longer as reliable as it was. It doesn't tell us as clearly what's going on in the economy, and the interpretation of this data is more ambiguous. I want to return to the topic of Trump and the dynamic and unpredictable policy making his return to office has delivered. For the US, there are multiple angles of policy uncertainty, covering regulation, education, immigration, taxation, and more. And for the US, there are a number of these which could be quite positive. Quite a few are expected to cut taxes, boost business dynamism, raise growth. But trade is clearly going to be negative. And for the rest of the world, it is US trade and tariff policy that matters, that is dominating the global geopolitical and economic narrative. And this is because it is almost uniformly negative, disruptive, and will have tangible negative economic effects. And that has the potential to be fairly disruptive to global real estate markets too. It's easy to see why we view this trade policy as so unpredictable. Since Donald Trump was inaugurated on the 20th of January, he has threatened nearly every country in the world with tariffs, and more than half the sectors of the global economy. He's issued threats, implemented policy, retracted it, issued other threats, postponed deadlines. The US has moved from an average tariff of just 2.2% to one of over 23%, where previous only 9% of US goods were tariffed. Now it is over 80%. And if we look at trade coverage, we've gone from that average of 2.2% to a minimum of 10% for every country in the world, and higher for the US's largest trade partners, Canada, Mexico, and China. And this is just where we are today. There's more to come, probably. Higher reciprocal tariffs, if they've been called, could take effect in early July, as soon as 2 weeks' time. These could push up the tariff rates on EU imports to the US to 20%, those from Switzerland to 31%. So, excuse me one second. And it was only a month ago that Trump threatened a 50% tariff on the EU on the Friday, and then wound that back on the Monday. We've further had the US Court of International Trade declare these country tariffs to be illegal, but also ruled that they can stay in place while an appeal is underway. So in short, we have a hugely volatile, uncertain, and dynamic tariff environment. We don't know where Donald Trump's next whim will take us. And this is only on the country level. There are also sector-specific tariffs. Some are in place, such as those on steel and aluminium, on cars and car parts. And there are others that are under investigation. This means that the Department of Commerce is conducting an investigation as to whether semiconductors and pharmaceuticals constitute a threat to national security. It's very likely they will find that they do, and then will impose tariffs. And then further, there are those sectors that are threatened, and this is far from a comprehensive list in any way. Foreign films, trucks and truck parts, and so on. Worryingly, this is just the start. This isn't going to be over in a couple of weeks. This may run throughout his presidency. We have the potential for a further escalation, even a de-escalation in the trade war with China. On the country level, we have the reciprocal tariffs due in 2 weeks. 90 trade deals were promised in 90 days. We've had 2. We're not likely to get another 88 in the next 2 weeks. But there may be special deals, carve-outs, free trade agreements that might put some countries, perhaps the European Union, in a better position. We don't know. Likewise, those sector tariffs, there are carve-outs. To add to this lack of clarity about this trade environment, we have the legal challenge I mentioned and others underway. We have congressional challenges to the US's, to President Trump's ability to impose trade policy, which is not within his remit. And then we also have the US midterm elections in November 2026, where the Republicans are expected to lose one of the houses of Congress. So in short, the only thing we can say is that trade policy uncertainty is not going to diminish anytime soon. It's going to continue to be a major determinant of that global economic and geopolitical narrative and a cloud hanging over real estate. So the question really is, what then does this mean for international real estate? I think it means three things. Firstly, perhaps most obviously, uncertainty isn't going to go away anytime soon. It will remain unusually high for as long as Donald Trump is president, and likely for a long time thereafter. How is this playing out? Well, in practice, we are already seeing businesses pause decisions, slow down investments, and cancel contracts. Whilst this is natural in the short term, we as real estate professionals and economic citizens cannot sit this out. We need to adapt to be able to make decisions in this dynamic and unpredictable environment. Second, economic growth is likely to be weaker than previously expected, and certainly it will be less predictable. High prices, particularly for construction-related materials and commodities, will persist, and future inflation, whilst it may not be materially higher, is likely to be more volatile and less predictable. This means that real estate businesses need to prioritize spending, focus on cost control, and position your business for a less predictable cost and growth environment. And in practice, what we're seeing at the moment is an increase in renewals or rollovers of existing leases in order to avoid taking on additional costs, fit-out costs. We're seeing examples of some companies cutting space requirements to keep expenses under control. And companies across the world, but particularly in Europe and Asia, have slowed or reduced hiring, adjusted supply chains, and put some transactions on hold. Third, it means an increasing desire for flexibility and adaptability. Businesses want more agility. They want to de-risk longer-term space and capital expenditure decisions, and they should be willing to pay a premium to do this. For instance, what we're seeing practically, the use of flex space is on the rise. There's growing demand for managed space solutions, and there's more interest in flexible leasing solutions and leasing terms. Companies are sensibly paying for optionality, paying to keep their future options open. I'm confident that these are short-term cyclical pressures that will pass. The real estate sector will survive Trump. It is adaptable, for sure, but it's also entering this crisis, for want of a better word, in a position of relative strength, at least compared to where the real estate sector was at the start of previous crises. I mentioned earlier that internationally the real estate sector has survived a few tough years. This is one of the reasons why it's well positioned or well placed now. Firstly, valuation risk is pretty low. Property values have fallen quite a lot over the last few years, meaning that today real estate is well priced or even undervalued in some places. So the risk of further falls as a result of disruption is pretty small. Second, supply side risk is low. At the start of previous crises, the construction pipeline was large, with lots of space due to enter the market in short order. This time, the pipeline is relatively empty. There is very little risk of oversupply, of new space hitting the market, lying empty, and pushing down rents and capital values. The demand side risk is limited too, or a better way of putting it is the demand side risk is neither acute nor concentrated in real estate. Most global real estate sectors have limited direct risk exposure to tariffs and their global knock-on effects, beyond the indirect economic effects. Those that do, such as logistics, have potential upside too. And lastly, as a result of Trump's dynamic policymaking, the US is not currently an attractive destination for international capital, meaning that Europe and Asia will be relatively more attractive and are likely to mop up more funds from international investors looking for real estate assets and opportunities. And lastly, real estate funding costs are falling as interest rates reduce, which should provide another pillar of support, offering that resilience. So that's a short-term view. The real estate sector faces challenges from lower growth, more volatile inflation, and higher uncertainty. But it's also in a resilient position and already acting to ameliorate these challenges. It's very short-sighted, or would be very short-sighted in times of crises, to expect these short-term cyclical challenges to continue and dominate the outlook for the sector in the long term. I don't think we should do that. To consider the long-term prospects for real estate, we need to step back from this day-to-day information overload. We need to tune out the unimportant and focus on what matters. In short, we need to separate the signal from the noise. This means finding the patterns, observing underlying trends. We need to focus on those fundamental trends that affect real estate and will continue above or in spite of the prevailing political and market environment. I want to highlight 4 trends that I believe permeate real estate and for which a focus on will help investors and developers navigate this VUCA geopolitical environment. These are polarization, collaboration, technology, and sustainability. Firstly, polarization. In real estate, we are seeing polarization along the lines of quality. What do I mean by quality? By the highest quality, I mean those buildings that are the newest, the smartest, the most tech-enabled, that are the greenest with the best ESG credentials, that are the best located where people want to be, and are the most aligned with occupiers, landlords, and investors pursuing the same objectives. What is the payoff from higher quality? It's that the best buildings are seeing the highest tenant demand, the highest occupancy, the fastest rental growth, the highest demand from investors, the tightest yields, and the greatest capital value growth. In short, a focus on quality delivers results, and this is true across markets and across sectors. But it also means a growing obsolescence problem for assets that don't meet these standards. It means that developers, owners, need to invest in refitting, retrofitting, or refurbishing assets so that they're greener, more efficient, and more attractive. And if that doesn't work, these assets need to be repurposed. For instance, there are thousands of retail and office spaces across Europe that only have a future if thought of differently. The second trend is collaboration. We are seeing greater collaboration of operations. We're seeing greater complexity of operations, greater complexity of regulation. We're seeing greater expense to hit quality benchmarks, to achieve return to office. And we're seeing greater ambition and need to go green, drive greater collaboration across different parties, across the business world, including in real estate. I'll give you some examples of what I mean. The pandemic and home working has highlighted the value of peer-to-peer collaboration and the benefits of in-work cooperation. Letting the cat out of the bag on working from home has encouraged greater employee-employer collaboration to get the best, not just out of staff assets, but real estate assets too. More relevant to this group, perhaps, is the growing collaboration between landlords and tenants, whose objectives are increasingly aligned on return to office, on ESG goals, on net zero carbon requirements. meaning landlords and tenants finding common ground on occupancy, energy efficiency, and other factors. The rising number of green leases is one example of this. And similarly, between owners and developers, greater collaboration is underway to deliver the right space in the right place, fulfilling the objectives of all parties, increasingly shared objectives such as those on ESG, occupancy, and so on, and hitting the quality benchmarks required for premium returns. Given the recent increase in construction costs, arguably it is only with collaboration that landlords and developers can provide the space that the occupiers want and are willing to agree to pay sufficiently high rents that mean this new space can be delivered at all. The third trend is technology, and this is probably the most obvious and least understood. New technology has always been a driver of change in the real estate sector. Over the last 200 years, we have seen 4 industrial revolutions with advancements in materials, energy sources, control systems, and other major technologies translating into innovations and progress in real estate. Now, AI is the topic of the moment, with February's DeepSeek launch showing there is more than one way to advance. AI will have a transformative effect on real estate. But it is not enough to just adopt AI. We need to adopt it with purpose, alignment, and clear goals in mind. And what does this mean for the future of real estate? Well, technology will transform cities, data will transform operations, and the two together will be a key enabler for achieving other corporate and real estate goals too. But we also shouldn't forget that technology can't do everything, at least not yet. This brings me to the final trend, and one that really runs through the others mentioned as well, that of sustainability. We see the emergence of the triple bottom line across companies around the world, measuring their success in terms of people, profit, and planet, and not just profit alone. Yes, the sustainability movement has taken some body blows from the change in the wind, change in the administration in the US, but this is a moderation of the trend at most, and not a reversal. Most markets around the world have climate target policies. The US leaving the Paris Climate Agreement puts it in a very small club alongside just Libya, Yemen, and Iran. We're seeing even more momentum at the company level rather than the country level. The number of companies that have signed up to the Science Based Targets initiative has increased 6-fold in the last 2 years and has now reached the critical mass needed to become the global target for reducing greenhouse gas emissions. And with real estate, or the built environment, accounting for 39% of CO2 emissions, real estate will be part of the solution to climate change, and sustainability a major driver of change for real estate. As Mark Carney, now Prime Minister of Canada and perhaps the future first governor of the new US 51st state, said, the net zero transition represents the greatest commercial opportunity of our time. And it's this word opportunity that brings me to my conclusion. I consider that we live in a VUCA world, one in which stock market volatility, policy uncertainty, geopolitical complexity, and data ambiguity mean we must navigate a dynamic and unpredictable business operating environment. In the near term, it will mean that growth is weaker than expected, inflation is more volatile, and decisions are harder to make. But we can't do nothing. We can't wait this out. In the short term, we need to prioritize cost control and become agile and adaptable. Over the longer term, our job is to separate the signal from the noise and determine how best to invest, develop, lease, and occupy real estate against this dynamic and unpredictable backdrop. We can do this by focusing on the major trends affecting real estate. These are not immune to geopolitical dysfunction, but they are not fundamentally altered by it. I called out 4 major trends that will shape the future of real estate. Those are polarization, collaboration, technology, and sustainability. There are many others you can and should consider depending on your line of business. But for me, these cut across geographies and across sectors. I believe that focusing on these trends and being clear on your values and priorities will allow you to deliver the best strategy and thrive in the real estate future of the world, even if Donald Trump takes a third term. So I'm confident there is opportunity out there, and you should be too. Thank you for listening, and I'll hand back to Antonio.